How an option strike price originates. The strike price of an option is the price at which the holder of the option has the right to buy, in the case of a call option, or sell, in the case of a put option, the underlying security. The strike price is determined at the time the option is issued and is typically fixed for the life of the option. The strike price is an important factor in determining the value of an option. Options with a lower strike price tend to be worth more than those with a higher strike price, all else being equal, because they give the holder the right to buy the underlying security at a lower price. This can be especially valuable if the market price of the underlying security increases significantly after the option is issued. There are a number of factors that can influence the strike price of an option, including the current market price of the underlying security, the time remaining until the option expires, the volatility of the underlying security, and the overall level of interest in the option. In general, the strike price will be set at a level that reflects the expected price of the underlying security at the time the option expires. In general, the strike price of an option is chosen to reflect the expected price of the underlying security at the time the option expires. For example, if a company's stock is currently trading at $100 per share and analysts expect the stock to be worth $110 per share in 6 months, the strike price of a call option with 6 months to expiration might be set at $110. This would give the holder of the option the right to buy the stock at $110 per share, even if the market price has risen above that level. The strike price of an option can also be influenced by the volatility of the underlying security. If a stock has a history of large price swings, options on that stock may have higher strike prices to reflect the increased risk. Similarly, options on securities with lower levels of volatility may have lower strike prices. Finally, the overall level of interest in an option can also affect its strike price. If there is strong demand for an option, for example, the strike price may be set at a higher level to reflect this demand. Conversely, if there is little interest in an option, the strike price may be set at a lower level. In summary, the strike price of an option is the price at which the holder has the right to buy or sell the underlying security and is determined by a variety of factors, including the current market price of the underlying security, the time remaining until expiration, the volatility of the underlying security, and the overall level of interest in the option. The strike price of an option plays a significant role in determining the value of the option. For call options, options with a lower strike price tend to be worth more because they give the holder the right to buy the underlying security at a lower price. If the market price of the underlying security increases significantly, the value of a call option with a low strike price will also increase significantly because the holder has the right to buy the security at a price below the market price. For put options, options with a higher strike price tend to be worth more because they give the holder the right to sell the underlying security at a higher price. If the market price of the underlying security decreases significantly, the value of a put option with a high strike price will also increase significantly because the holder has the right to sell the security at a price above the market price. The relationship between the strike price and the value of an option is known as the intrinsic value. The intrinsic value is the amount by which the option is in the money, or the difference between the strike price and the market price of the underlying security. For example, if a call option has a strike price of $100 and the market price of the underlying security is $110, the intrinsic value of the option is $10. In addition to the intrinsic value, an option may also have what is known as time value, which reflects the potential for the option's value to change due to changes in the market price of the underlying security or other factors before the option expires. Time value is also known as extrinsic value. The total value of an option is equal to the sum of its intrinsic value and its time value. I hope this helps. Let me know if you have any more questions about the mathematical fundamentals of option strike prices. Call Suzanne for more info.